Okay, the next topic what we have is overhead cost. Overhead costs are also called as indirect cost. See, there is another classification. Yesterday we have learned few classifications. So one was based on elements of cost. Then we seen behavior wise, function wise, production cost and non-production cost. Um, behavior wise variable, fixed, semi-variable, and there was step fixed cost. See, another classification of cost based on their identifiability. We have two types of cost. One type of cost is called as direct cost and indirect cost. The one classification says that they are identifiability. If that is taken, we see that we have direct cost. If the amount can be identified with a cost object, so with the cost object how much of the amount is spent, if that part can be understood, we call that to be as a direct cost. If that is not known, if we cannot find out that part, then it becomes an indirect cost. So yesterday I gave you few examples that a factory rent, because it cannot be identified with the product or service, it's a common cost, it's a joint cost which is incurred. Therefore, in some way, this has to be divided and distributed. Then supervisor salary or things like that, they are not direct in nature. They cannot be identified with the product or service. Heating, lighting, coal, gas, fuel. So these are all items which are incurred for the um, for some function of the business, that is production, or some examples we have in administration, selling and distribution. So there are certain costs which are identified, which are incurred but not identified with the cost object. So if they are not identified, we call them as overhead cost. If they are identified with the cost object. Now, what is a cost object? Yesterday we learned about it. What is a cost object? Any entity with which we can identify the amounts, like it could be a product, it could be a service, department, division, center, then a function of the business, production, administration, etc. So anything with which amount can be identified, we call that to be as a direct cost. Otherwise, it's called as indirect cost. So in case of production department, we have direct cost and indirect cost. Then in case, if the cost object is taken to be as the product or service, then we see that um, for the three functions of business: production, administration, selling and distribution. So in case of production, we see direct costs are incurred and indirect costs are incurred. In case of administration, all costs which are incurred cannot be identified with product or service. They are, yesterday also I explained to you that they are also called as period costs. So they are incurred for a period of time. So what we see is administrative, selling and distribution, they cannot be identified with product. So all those costs which are incurred at administrative, selling and distribution, we call them as overhead costs. How do we account for these overheads is the criteria now. How to account for the indirect costs or the overhead cost. All indirect costs together we call them as overheads. The cost of units of output produced should reflect the full cost of producing them. Therefore, all production costs, including overheads, need to be included. What does it mean? It means to say that, see, one of the objectives of cost accounting is to determine the cost price per unit. How do we find out what is cost price per unit? Cost per unit. This is equal to total cost incurred for the production of a product. So we have total cost divided by the number of units. Now, what is total cost? Total cost is if the costs are identified with the product, then we charge them. They are direct cost. But if they are not identified with the product, then some basis of apportionment is taken, and then those costs also um, okay, how to find out cost per unit is there are both direct costs and indirect costs which are incurred. So if we can identify them, we charge it like material cost, labor cost. So if the identifiability is there, they will be charged to the production of a product. Then indirect costs have to be divided and distributed. See, for example, if I say factory rent will be divided and distributed based on the space occupied. Supervisor's salary, how much time does he spend on the production on supervising each product? We will take that time, take it, and then divide and distribute that amount. For example, power, how many units were consumed by the production of a particular product, we take that and divide and distribute. So like that, overhead costs should be divided and distributed. After that, we accumulate the total cost. Once the total cost is accumulated, we divide it by the number of units. So then find out what is cost price per unit or cost per unit. Once cost per unit is known, it becomes possible to know what is the selling price per unit. So determining the selling price per unit is also the objective of the of cost accounting system. So for that reason, see, though costs are incurred for direct costs and indirect costs separately, we have to come down to the point of charging all the costs which are incurred for the purpose of production, producing a product. Then, if we know them, how much is incurred for that product, we charge it directly. If we do not know, then we have to divide and distribute. So here it says that there are three steps in the process of accounting for overhead cost. The first step talks about allocation and apportionment of fixed production overhead cost to production cost centers. So anything which is incurred in the factory level, any production overheads, they should be first charged to the production cost centers where the production work is carried on. Then reapportionment overheads collected in service cost centers to production cost centers. Then absorbing overheads from production cost centers into cost units. One classification of divisions is or departments, we classify them based on the activity which is carried on. So we see there are two types of departments. One is production departments. Another one is service departments. What are production departments? Production departments are those departments where the production work is carried out. What are service departments? Service departments are service departments render service to other departments like a canteen department. So there is nothing production going on there. So they render service to the other departments, lighting, heating. What do? They provide some service. So their costs are incurred, but they are not identified with any particular product. They are just rendering services to other departments. So broad classification of departments are production department and service departments. So the first step talks about sorry. The first step talks about allocation and apportionment of fixed production overheads to production centers. What does it mean by allocation, and what does it mean by apportionment? Allocation is if we can identify the cost with the department, we charge it directly to that. If we cannot know that, then we divide and distribute. That is called as apportionment. So the overhead costs are apportioned to the departments. Step number two is, since the costs are incurred by the service departments also. See, the objective is to see that cost per unit is to be calculated. But now costs are scattered across production departments and service departments. So service department also would have incurred some costs. So as many number of production departments are there, let's say one, two, three, this many number of production departments are there. There are two service departments, for example. So all the cost which is incurred by service department should be charged to other departments. So from service department, we charge these costs to other departments. Like that. Likewise, service department two costs also have to be charged to one, then two, then three. So what are we doing basically? By doing so, we are accumulating costs in the production departments. Now everything will be ultimately identified with the production department. So in each of the production departments, the number of units which are produced, so charge the total cost to each unit of the um, product produced. So cost per unit can be calculated, and then we can find out what is selling price per unit. So that is the concept what we learn under overhead accounting. Step number 3 talks about absorbing overheads from production cost centers into cost units using a predetermined overhead absorption rate, that is overhead absorption rate. There are production cost centers and service cost centers. A cost center directly involved with the production is called as a production center. Service department, service cost center is where the services are rendered to the other departments. Okay, if we have the next concept is allocation and apportionment. If there are two production departments and two service departments, first step is allocation is costs which can be identified are charged to each production department. Then we have the apportionment. If some of the costs which are incurred combinedly jointly, they have to be divided and distributed among all the centers, cost centers. So we see costs are incurred for the production departments, costs are incurred also for the service departments. So take the service department cost and charge it to production department. So that is what will happen. Typical service cost centers might be canteen, stores, maintenance, welfare, repairs, and then power supply, electricity. These are all examples of service cost centers. Now, how do we charge the overhead costs of the service department to the production department? So there's one example given here. Let's take this example and work it out. One second, I'm opening an Excel file. Okay. I hope you can see this one on the screen. Um, how to charge the service department cost to production departments. There are two production departments A and B. There are two service departments C and D. Now, in this case, production costs, overhead costs are incurred by all of them. Department A, that is production department A, production department B, service department C, service department D. After that, use of service departments. See, service department C is rendering services to A, B, and D. So, in what proportion? 45% of the services provided to A, another 45% of services provided to B, the remaining 10% of services provided to service department D. Then service department D, on the other hand, 35% of their services are towards production department A, 60% is towards production department B, and 5% of the services are to the service department C. So we are asked to find out about how do we charge these costs to reciprocal service method. See, there are various methods which are used for charging the service department method. So I'm putting it here. The first method is under reciprocal service method. So the solution is given to us. Once the overhead costs are given, see, these are the overhead costs, and then the charging starts. How to allocate that? So what do we see is this goes on and on, repeated distribution method. I will show all of them on the in the Excel sheet. So this is one thing about repeated distribution method. Otherwise, we have it as reciprocal servicing equation method. So let's take it up. So let's start writing the. There are two production departments. And there are two service departments. So first one, production department. First, let's do repeated distribution method. See, under production department, there are two departments, A and then B. Then we have it here, C and D, service departments. The overheads are incurred by all of them. Overhead costs are incurred by all of them. We see 10,000. Then we have 25,000. Then we have 2,100. Then 1,500. So what is the objective here? The purpose here is to ensure that all the costs are identified only with the production department, because ultimately we need to find out what is cost price per unit. So if that is the case, the cost should be only known with the production department. So in the production department, find out what's the total cost and divided by the number of units gives us what is production cost per unit. But now we see that overheads are incurred by all the departments, both production departments and also the service department. So first step is we should start charging the service department cost to the production department. So we start with the first service department. First service department is service department C. Now this has to be charged. So we will also mention what is the ratio in which the cost should be distributed. So service department C is charging the services to A, B and D in the ratio of 45%, 45% and 10%. So the ratio would be 45 is to 45 is to 10. So total parts are 100, 45, 45, 90, 90 plus 10 is 100, 100 per parts. So the total cost of service department overhead is 2,100. Do you see that? This 2,100 will be charged. So it is equal to 2,100 into 45%. Now C is rendering services to D also. So 2,100 into 10%. 10% of the service is provided to D. So charge it to D. Now, when we total it up, C has absolutely nothing because C's amount is taken and charged to A, B, and D. So ultimately now C has nothing left. C it is 0, but D has total amount of 1,710, which is 1,500 which is incurred by itself and then 210 received from service department C. So nothing should be there in service department. So take this amount of 1,710 and charge it to other departments. So now let's start with service department D. Service department D. Now what is the ratio for service department D? 35%, 60% and 5%. So in this ratio, costs have to be charged. So what do we see here? The amount is 1,710 into 35 percentage, 35 by 100. Then we see is equal to 1,710 into 60 by 100. So then what do we see? The total amount of 1,710 is taken and charged to the other departments. So when we total it up, D doesn't have anything because it's already charged to other departments. But now C has received 86 from D. Earlier, whatever 2,100 which was there in their department was already charged to other departments. So now 86 is received from service department D. So now this 86 is there in service department C. 86 again has to be a portion in the ratio of 45 is to 45 is to 10. So let's take it up again. But this time it is not 2,100, it is just 86. So there's some slight this thing that is we have rounded it off. So now So minus 85.5. So nothing is there. Take 9 now. In the similar fashion, take 9 and charge it. So it goes on and on and on until we can ignore the amount. It becomes negligible. So until then, we have to go on doing this one. So service department D, the ratio is 35 is to 60 is to 5. So now take minus 9 and charge it to other departments. So here it would be 9 into 35%. So 0.45. I think we can ignore at this particular stage and then just ignore that. This is so 0.45 can be ignored. So this is a method called as repeated distribution method. Repeatedly we keep on doing because one department is charged, providing service to other service department. So when the costs are when the costs are charged to other departments, so again and again they keep receiving amounts from other service departments. So this process has to go on repeatedly, continuously. It has to go on until a point where we can, whatever is the remaining amount in any particular service department, we can ignore that. So till then, this work has to be repeatedly carried on. That's why it's called as repeated distribution method. So now here what we can do is, instead of taking it up repeatedly, in one step, um, prepare the simultaneous equations. So equation method, simultaneous equations are prepared, and then by solving the simultaneous equation method, what is the amount of overheads which are to be charged to each department can be identified. So let's start with the simultaneous equation method. What do we do here? See, service department C has 2100. So service department C will have to charge this cost of 2100 to other departments C, A, B and D. Okay. So C will charge a portion of the cost to D. In turn, C will receive a portion of the cost from D. C to D and from D to C. Based on this concept, what do we do is we prepare simultaneous equations. But once if this is all done, we can find out what is the total cost which is charged to production department. So this will be total cost. Total cost now identified only with the production departments. See, the total amount of cost in the production department A is 11,585. Then we see B is 27,015. C anyway we are ignoring that, less than 0.5 we are ignoring. So it's almost equal to 0. D also 0. So all the costs are now only identified with production department. So in each of these departments, the number of units which are there, if these costs are divided by the number of units, we would be able to calculate what is cost per unit. So that is the logic behind taking up this activity or this exercise. Now, instead of doing it in the repeated distribution method, what we can do is we can frame the simultaneous equations method. So simultaneous equations method, what does it talk about? It talks about the service department C is going to charge a portion of their cost to D, and in return will receive a portion of service department D cost. So what do we do is we frame equations. So C is equal to, because the departments are already mentioned. So let's frame the equation. C is equal to, C has incurred 2100 plus it will receive a portion from D. See, now here what do we write here is very kind of confusing also, but we have to be very careful. What are the use of service department? Service department C will give 10% to D, but will receive 5% from D. Do you see that point? Don't ever make a mistake of writing it the other way. Service department C will receive, because D is providing services to A, B, and C. C, it is 5%. So 2100 anyway they have incurred, plus they have to receive 5% of D department's cost. So this is equation number 1. We wrote it as, so this is C is equal to 2100 plus 0.05 D. Now we have D is equal to, D also has spent the amount, D is equal to 1500. So 1500 plus will receive a portion of the cost from C, which is 10%. So 0.10 C. Now there are two equations which we see. Two unknown variables are there in these two equations. One is C, one is D. What we can do is take any one unknown variable, substitute in the other equation. So if we are taking C is equal to 2100 plus 0.05 D, substitute in equation number 2. Substitute equation 1 in equation 2. How does it look? D is equal to 1500 plus 0.1 into in place of C, write 2100 plus 0.05 D. Substitute what it is. 0.1 into 0.05, how much will it be? What is 0.1? So 210. 210 plus, this will be 1 into 5 is 5. 1, 2, 3. 0.005 D. So D minus 0.005 D is equal to 1710. 1 minus so we have it here as 0.995 D is equal to 1710. So D is equal to 1710 divided by 0.995. So that is Once we get what is the value of D, I think we will be, we can find out, round it off, and then we can find out what is the value of C. Substitute D in C. C already we know C is equal to 2100 plus 0.05 into 1790. 2186 C is equal to. Okay. So after this, we need to know how much is the total cost charged to A and B. So A is equal to, A has spent 10,000 by itself, plus A will now receive 45% of whatever is incurred by C. C, which is 2,100, plus it will receive 35% of whatever is spent by D, which is 1,500. Check how much is this, is equal to 10,000 plus 2,100 into 0.45 plus 1,500 into 0.35. So 11,470 is A. B will be one small mistake I made. Just a minute. C is not 2,100. Now C has a new value 2186. 86, and D is 1719. 1719. B is equal to, B has spent on its own 25,000, plus it will receive a portion, that is 45% into 2186 plus 60% into 1,719. From when are you not able to? From a very long time you are not able to see this. You could have, oh my God. You can speak on the mic also. See, the chat is always not highlighted on the screen for me. Um, use use the mic. Small class only, no, so nothing will happen. You can use the mic. Okay, repeated distribution method. Repeated distribution method. Overhead costs are incurred like this. Then service department C costs are charged here as 45%, 45% and 10%. So the ratio will be 45 is to 45 is to 10. So we have done the calculation. See, department A 2100 into 45%. Here the formula bar you can see. Then similarly for department B also. Now department C 2100 is taken and charged to department D 210. So we see that nothing is left in C, 0, but D already 1500 what it spent and 210 received from C. So it is now 1710. Take 1710 and charge to A. So 1710 into 35%, because these are the percentages, 35% and 60%. 35%, then we see 60%. Then C also will get 5%. So 5% is charged. Now nothing is left in now nothing is left in D. It has become 0, but C received a new amount which is 85.5. So take 85.5 and charge it to other departments A, B and D. So A will receive 86 into 85.5 into 45%. This one also will receive 85.5 into 45%, and this will receive 85.5 into 10%. So nothing is left in department C. D 9 it is received. So charge this 9 to other departments. When I was telling like this also, you didn't realize that I was working in the Excel sheet.
Ma'am, we had a confusion, that's why.
No, did you see me pasting this thing?
No, no, no. Only the textbook, what was visible.
You didn't even see I starting a Excel file at all.
No, no.
Okay, okay. Anytime when you get a doubt, speak like this on the mic. Done. Um,
Okay, ma'am.
yeah.
Ma'am,
So
can you repeat from the start? I did not get the question. I did not understand this one.
okay.
Problem.
We're talking about overhead costs. Overhead costs which are incurred. There are two different types of departments. One is production department, another one is service department. Production department, where the production work is carried out, only the production work. But there are certain other departments where there is some other activity other than production, which is taken up, like maintenance department is there, canteen department is there, power department. What do? They do not produce anything. They do not produce any product, but they render services to the other departments which are there in the factory. So there is one example which is given. We'll come back to Excel. Remind me. We'll come back to Excel. So there is one example which is given here. Reciprocal servicing. After explaining the reapportionment of service cost, there is one example question which is given. Reciprocal servicing. CBC, the example says that there are two departments: production department A and B, service department C and D. All of them have incurred costs, overhead costs only. So overhead costs which are incurred, A has incurred 10,000, B 25, C 2,100, D 1,500, and the percentages are mentioned as department C is charging um, 45% to A because it has provided services to A to the extent of 45%. Then B also 45%, D 10%. If it is service department D, D has charged 35% of the services to A, 60% of the services were provided to B, and 5% of the services were provided to C. So this is the situation which is given to us. There are various methods in which we you're able to see the screen, no? Excel
Yes, ma'am.
screen, Excel. Okay. So these are the costs which are incurred. So what do we do basically here? Take each department, service department C, the cost we take it, and then charge it to A and then B. Takes D, D also has to be charged to A, then D also will be charged to B. But it is not that they are only providing services to other production departments. They would be providing services to other service department also. So if there is a power department, power will be provided to other service departments also. Canteen will provide canteen services to other service departments also. So it is not exclusively to the production departments that they are rendering services. So what did we do here? First mention what are the overhead costs. So 10,000, 25,000, 2,100, and 1,500 they are spent. Start with the first one, that is service department C. Take service department C, take the amount. So because this will be charged to the others, put a negative here, minus 2,100. So 2,100 is now going to A, B, and D also, because the services which are provided by C are to A, B, and D. That is the point there. In what ratio? The ratio is 45 is to 45 is to 10. So that's the ratio in which the costs are charged.
Ma'am, 45% of what amount is taken?
45% of 2,100, because the total service whatever is provided, 45% of that is to A. So the calculation here you can see it in the formula bar. 2,100 is the amount spent by C. So out of 2,100, 45% of 2,100 will be charged to A, because they have given that percentage of services. So out of their cost, 45% of the cost will be charged to A. So 2,100 into 45%. Do you see that? B also, look at the formula bar. Here it is the formula bar, because I wrote the formula
Yes, ma'am.
here. Okay. So B also in similar manner. Now D is 2,100 into 10%. So
Okay, ma'am, understood.
yeah, C has absolutely nothing now. Now D received 210. So earlier 1,500 and 210 together it is 1,710. Take 1,710 in the ratio of 35:65. Altogether added it is 100 parts, no? 35 by 100. So 1,710, look at the formula bar, 1,710 into 35 by 100. So then here it is 1,710 into 60%, 1,710 into 5%. Earlier C became 0. Now it received 85.5 from D. Okay. Earlier, whatever was there, it was already charged. Now it has again received from D. Take this 85.5 and charge it to A. So 85.5 into 45%, 85.5 into 45%, 85.5 into 10%. So D earlier became 0. Now it has received 8.6. Take 8.6 and then charge it to roughly 9. Take that and charge it to A in the ratio of 35 is to 60 is to 5%. So we repeatedly take up this until one department it becomes 0, the other department also it's almost close to 0. So we can just simply ignore that. So now when they are totaled up, production department A has 11,585, production department B has total amount of 27,015. So this is called as the repeated distribution method. Repeatedly it is done. The apportionment of it is repeatedly done till we see that there is absolutely nothing left in the service departments. All the service departments, there's absolutely nothing left. Until then, repeatedly the work is carried on. Okay. Now, instead of doing that, there is another method which is called as simultaneous equations method. So what do we do with simultaneous equation method is frame two equations, simultaneous equations. C is equal to, C has already spent 2100, but we see from this particular statistics here, the table here which is provided, C spent 2100, but C will receive 5% from D, because costs are charged 45 to A, 45 to B, and C will be charging 10% to D. So D will receive 10%, and on the other hand, D will provide 5%. D is providing 5% of the charges to C, so it will take 5% from C. So what do we do is we have to frame the equations. Framing the equation is the important aspect here. So C has spent 2100 plus it is going to receive 5% from D. So 0.05 D, that is equation 1. D on the other hand 1500 plus zero point 0.1 C, that is equation number 2. Because two unknown variables are there, one unknown variable will be substituted in the other unknown variable. So in that manner we proceed and then calculate what are the amounts. So what did we do here in this particular situation? We have used equation 1 and substituted in equation number 2. Equation 1 is equal to C is equal to 2100 plus 0.05. So here in this place, when I was working, it would have been much better, but doesn't matter. So this point, this C, the entire 2100 plus 0.05 is substituted here. So we could calculate C is equal to 2186 and D is equal to 1719. So now what are the total cost of A and B? So A is equal to, here I stopped. So let me finish this one. A is equal to 10,000 which it has spent plus 45% from C. Now C is 2186. So 2186 into 45% plus 35% from D. So D now is 1719. So 1719 into 60%, into 35%. I'm sorry, here 1719 into 35%. So the amount is 11,585. B on the other hand spent 25,000 plus it has received 25,000 plus 45%. 45% of 2186 plus 60% of 1719. 25,000 into 2186 into 35%. 0.35 plus 1719 into 0.60. So we got it as 26,796. 27,015. I'm really sorry. Let's check this one. Okay. So this is how it is done. Um, I hope it's clearer. Did you understand this part? Respond. Okay. Um, let's move ahead. I didn't realize one bit also that something like this was happening. Absorption into cost units. So absorption into cost units. See, once the overheads are all charged to the production departments, now all the overheads are only identified with the production department. There's absolutely nothing left in the service department. So then um, the next part of it comes as absorption of overhead costs. So what's the formula? The formula here, it says that budgeted production cost center overheads divided by budgeted quantity of absorption base. What does this indicate? Here it says that fixed production overheads that has been allocated apportion, reapportion. So till then we have learned allocated, directly identified, apportion, charging, reapportionment of service department cost to um, production departments. After that, into production cost center is then absorbed into cost units using a predetermined overhead absorption rate. Here, did you ever do cost sheet after you have joined the graduation program? Did you work out any one question also of cost sheet? My question is simple only, no? Cost sheet, did you work out even one question on? Did you learn this topic in your degree program? Did I ask such a difficult question? Did you do a cost sheet is what I'm asking, cost statement. Okay. See here, the cost statement, the format of cost statement looks like this. So first we write the direct material, then we write the direct labor and the direct expenses. So the sum total of it is called as the primary cost. Not primary, prime cost. I'm really sorry. So the sum total of it is called as the prime cost. So to this prime cost, we start adding the overheads. But overheads are many in each department. Each production department also, we see that there are many overheads, like in production department one, starting from lighting, heating, coal, gas, repairs, maintenance. There are many items of overheads. So now all of them have to be, overheads are basically not identified with the cost object. Therefore, now we have to start identifying or allocating that and then charging it to each product. So that is what has to be done. But the list is a very big one. So instead of doing that, what is done, the regular practice is take all the production overheads. So first take the production overheads. Earlier, some rate which is assumed to be calculated, instead of charging the actual overhead cost, they take some basis and then estimated amounts are recorded. For example, in the last year, if they have seen that direct labor was 20,000, factory overhead was 5,000. So they establish a relationship between that, or a rate is calculated. See, when 20,000 was 100%, 5,000 is what percentage? So that percentage is called, or that rate is called as predetermined overhead rate. Henceforth, every time whenever they prepare a cost statement, they take that overhead rate and charge it instead of accounting or recording for all the overhead amounts, individually take them and take the item, divided and distributed. Instead of doing that, one estimated overhead amount is calculated and recorded in the cost sheet, cost statement. So for that reason, there is an overhead absorption rate which is calculated. Overhead absorption rate is equal to budgeted production cost center overheads divided by some base of absorption. It could be the number of units, it could be the direct labor hours. Mostly the overhead absorption rate is calculated based on the direct labor hours or cost or something connected to direct labor mostly, but other things also can be taken. That is number of units or machine hours or activity based cost is a solution to the limitations what the overhead absorption rate has. So that's a different method altogether. So that also we will be looking into. So overheads are calculated based on a predetermined overhead absorption rate. So then instead of recording the actual overhead cost, they record some assumed or predetermined overhead rate based on which the overheads are calculated and accounted. So will the total actual overheads and the absorbed overheads match with each other? They wouldn't match. So then they take up an reconciliation. They compare that what's the actual amount incurred, what is the amount accounted in the cost sheet. So find out the difference between these two. If it more amount is charged, we call that to be as over absorption. Less amount is charged, we call it as under absorption. So either an over absorption or under absorption of overheads is identified. Then they take up the reconciliation of these under absorption or over absorption. So that will be taken into consideration. So let me put you to the example which is given here. I'm erasing the screen. What is under absorption or over absorption? So the overhead absorption rate is calculated using budgeted figures. Then it will be charged to the cost statement, charged to the product. So on comparison of what is the actual overhead and how much did they record in the books of accounts. So in the cost sheet, how much did they account? How much is that they actually spent? When these two things are compared, what they have charged is less than what actually incurred. It's called as under absorption. If they have accounted more cost than what is actually incurred, it is called as over absorption. Okay, so actual overhead is different from the budgeted. So this is called as the under absorption or over absorption. There is an example given here. Budgeted fixed overhead is equal to 60,000. So that is what they have decided to account for. Then the activity is given as 1,500 units. If in case the budgeted overhead absorption rate is to be calculated, it is calculated as 60,000 divided by 1,500. So $40 per unit. So that is what we calculate this. Now, henceforth, in the cost statement, they will start charging the overheads based on this rate at the rate of $40 per unit. During the period, actual result where the results are their actual fixed overhead cost spent is 50,000. The actual units produced is 1,200. So instead of recording 50,000 as it is, they do not record 50,000 as it is, but they follow this method of charging or recording the overhead cost based on the overhead absorption rate. What here in this example, what did we get? We got it as $40 per unit. That is what we got it. So they stick to that and then calculate. So overheads absorbed are, actually they have spent 1200. So 1200 units into 40 per unit. So comes out to be as 48,000. But how much did they actually spend? Actually spent is 50,000. Did they account 50,000? No. Did they account less than 50? Yes. So they should have recorded 50, but they recorded only 48. So that is resulting in under absorption of overhead. Okay. Do you understand that?
Yes, ma'am.
Okay. Um, the only reason why they would do this is because the list of items are many. Individually, each item to divide and distribute it is not possible. Then what is done is, like this method, they absorb the overheads, and finally they compare all the overheads which are charged versus the total overheads which is spent. If there is a difference in these overheads actually spent and charged, then they take up a reconciliation statement and reconcile it. That is as simple. So for ease, for the purpose of easy doing, that is what is followed. Now the next topic what we are going to start now is about marginal and absorption costing. Yesterday one of the second year students was asking about absorption costing. I hope they are there in the class. Somebody from the second year class has asked for absorption costing. I do not know who is it. I don't remember the name. Assuming they are there. See, there are two methods um, of accounting for cost. Cost statement, when it is prepared, when the costs are accounted, there are two methods. One is absorption costing, which we also call it as full costing method. All the costs are accounted. Mm, and marginal costing is another method which categorizes the cost as variable cost and fixed cost. So let's learn some basics about the marginal costing and the absorption costing, and then from there we'll try to understand. See, absorption costing is also called as full costing. So what is full costing? Sales minus full cost or total cost is equal to profit. So that is their concept. No distinction which is made between the total cost. So sales minus total cost is profit. On the other hand, we see marginal costing. Marginal costing distinguishes this total cost as, see, the profit which is ascertained is the same thing, but it says that total cost is split into variable and fixed, broad category, variable cost and fixed cost. Because fixed cost remains fixed in nature, it would not change within the relevant range. For any activity level, it is the same. So marginal costing takes only the variable cost, which is also called as the controllable cost. By making a change in the activity level, variable cost also varies. So that is called as a controllable cost. Then there is uncontrollable cost. So any activity level, even if it is at zero level, also fixed cost is the same. Any activity level within the relevant range, fixed cost is the same. It is not altered, it is not changed, it doesn't get affected. Therefore, marginal costing distinguishes between these costs and deducts the variable cost and takes out the resultant figure to be as a profit. But this is not the final profit because still fixed cost has to be absorbed. So sales minus variable cost is a profit which is a controllable profit. So there is a term which is given to this one called as, this is called as contribution. Okay. Now this contribution from this, if when fixed cost is deducted, the resultant figure is profit. See, the profit under marginal costing and the total profit under the absorption costing, both of them are same, but in between there is a distinction made between what amount of it is variable cost, what amount of it is fixed cost. That's one point which is taken into consideration. So all the assumptions are based on this distinction that cost can be classified as variable cost and fixed cost is taken into consideration. Based on that, it is followed. So sales minus variable cost is contribution. Contribution minus fixed cost is equal to profit. Okay. Um, so contribution is equal to total sales minus variable cost. So until here, we understand what it is. So now, how do we differentiate between marginal costing and variable costing, and what is that point of difference? So that is what has to be looked into. I'll just put you to the a whiteboard. I am erasing this particular screen. Now, let's see, in our trading account, if the income statement, the first part of it, if we present it in the T form, you also know that on the debit side, we have the opening stock. Rather, we have the value of the opening stock. But let's only look at what is the, what are the items. First is opening stock. Then we have everything which is incurred related to the production. That is material cost, all the overhead costs which are incurred for producing the product. So production costs are there. Then on, now this is the value of all the units which are available for sale, which can be sold. So the value of the opening stock and the value of production is accounted on the debit side. Out of that, few units are sold. So if the units which are sold is the value of the units which are sold is sales, we account it as sales. What about those units which are not sold? If they are not sold, we call that to be as closing stock. Sales will have a value because selling price is decided. Selling price into number of units gives us sales. But what's the value of closing stock? Opening stock has a value which is brought from the previous period. The production units also have a value because the costs are incurred, labor cost is incurred, all overhead costs are incurred. So we have these values also, production cost values also are known. Sales value is also known because number of units sold into selling price per unit. Sales also we know. Then what is that we do not know is about what is the closing stock. Okay. How many number of units which are unsold, what value do we charge? Absorption costing here, okay, absorption costing charges the total cost of the closing stock as, see, production cost. The production costs, we can categorize them as variable cost and the fixed cost. So that we have already understood. So both of them are taken into consideration. The total cost is taken proportionately from the production cost. Proportional production cost is both variable and fixed. So that is the total production cost. A portion of it is charged to the closing units, the ending units which are not sold. So if this is the total cost which is charged, the total cost of the production for the number of units produced, if that is known, a portion of it is taken and charged to the closing stock. Okay, that is under absorption costing. So absorption costing does not make a distinction between variable overheads and fixed overheads. All the costs are taken and then we charge that proportionately. Let's say that the number of units produced are 2000, number of units unsold are 200. For 2000 units, whatever is the cost which is incurred, a portion of it will be charged for 200 units as closing stock, value of closing stock. It's simple, it is logical, it can be understood. But marginal costing, on the other hand, instead of charging proportionate amount, it does not regard this fixed cost. Only a portion of the variable cost will be charged. Variable production cost, all variable costs only are considered. Variable production costs are considered for charging a value to the ending inventory. So will they be charging more cost or less cost? It's less cost because only one portion of the cost, that is variable component, is charged to the ending inventory. Whereas absorption costing, on the other hand, it charges proportionate amount of the total cost, full cost. So even a portion of fixed cost also is charged to the ending inventory. So absorption costing value of ending inventory is high. Marginal costing value of ending inventory is low. Only variable cost is charged. I hope it is clear. This is the main point of difference. So on account of that, if the closing stock is high, we see that the profit also would be high because the credit items minus the debit items is profit. So profit also would be high. If the closing stock is low, the profit also would be low. I hope you understood the point. If the closing stock value is high, profit will be high. If on the other hand, if it is low, then we see that the profit also would be low. So it depends on what is the value of closing stock. So now let's go back to the presentation part of it, and let's see trades marginal costing. It does not charge the fixed production cost to the ending inventory. Inventory is valued at marginal cost only, marginal or the variable cost only. But on the other hand, absorption costing charges the inventory with the full value. Inventory is valued at full production cost. So when inventory is valued at full production cost, a higher amount of cost is charged to the ending inventory. So we see the profit also to be higher. Marginal costing, the profit would be lower because less amount of value is charged to the ending inventory. That is the main point of difference between absorption costing and variable costing. Absorption and marginal and absorption costing profits. So marginal costing statement follows the equation, marginal costing equation, that is sales minus variable cost, variable production cost, then other variable costs. So variable costs are incurred in selling and distribution also. So there also there might be a variable component of it. So all variable costs in the first hand, they are deducted. Sales minus variable cost is contribution. From that, the total amount of fixed cost is deducted. Okay, that's the equation of marginal costing. Absorption costing is, we have sales minus the cost of goods sold. Cost of goods sold is opening stock plus the production cost minus the closing stock. So that gives us what is cost of goods sold. So when that is deducted, we arrive at what is the profit, gross profit. So any non-production costs are there, they would be deducted. So this portion of it is called as the cost of goods sold. So sales minus cost of goods sold, if this is deducted, cost of goods sold is calculated as opening stock plus production minus closing stock. So when this is deducted, the resultant figure is called as gross profit. Then we have the P&L account items also. Those P&L account items are deducted from gross profit. So we have the final overall net profit is there. So sales minus cost of sales is called as gross profit. From that, we see that non-production costs are deducted, and then the resultant figure is called as the profit or loss. So now a reconciliation between the marginal costing and the absorption costing. So whatever is the point of difference, that is adjusted. And then the profit, one particular method profit is reconciled with the other method profit to identify everything was done according to the methods, appropriately done according to the methods. So absorption costing profit is there. So we have this one. Then see, once the closing stock is valued in a particular fashion, it will go to the next period as opening stock. So from the previous period, the closing stock was carried forward to the present period as opening stock. So the opening inventory minus closing inventory, the difference in that adjusted according to overhead absorption rate. And then we find out what is the marginal costing profit. So that's how reconciliation between these two profits is taken up. Theoretically, that is what is marginal costing and absorption costing. If time permits, day after tomorrow is the last class. If time permits, maybe we'll work out one question. But take my word, time would not be available. The content is so vast that I will not be able to take up even one simple question also here. Um, Next year you will learn about P1. So at that time, whoever is the faculty, they will take you through the numerical questions also. So then you can practice some of them. The next concept what we have is what are the pricing decisions. Pricing decisions, how is selling price decided? Selling price is decided by adding profit margin to the cost price. Cost price plus profit is equal the selling price. Plus a profit margin is added. The selling price is calculated by adding a markup to the cost. Markup is a margin, profit margin. Markup added to the marginal cost or markup added to the full cost. So there are two ways in which the selling price is decided. Now, when is that? See, otherwise, if there is nothing mentioned, we take the total cost, add a profit margin, and find out what's the selling price per unit. So that is what we know. That's conventional, traditional method of deciding what is the selling price. Done. But in certain situations, we also see that the selling price is calculated by adding only the marginal cost or the variable cost. Take only the variable cost, accumulate that, add it up, and then to that add a profit margin. A markup is added to the marginal cost and decide. Why would they add? See, marginal cost is definitely less than the total cost. So why would they consider or decide the price to be so low? Is I'll try to explain, try to understand this one. So there is one cost which is fixed in nature, which is called as fixed cost. Let's say this is activity level on the x-axis. So the activity level is mentioned on the x-axis, and on the y-axis, if you are talking about the cost, so there is a cost, fixed cost, which is fixed till it reaches the maximum capacity. This is the maximum highest capacity. Until this, we see that the fixed cost is the same. Now, let's say that, for example, if they are at present operating only at 80% capacity, they are not producing uh, all whatever is available. They are not operating at 100%, but they are only operating at 80%. So there is some capacity which is available, spare capacity is available, that is additional 20% capacity is spare capacity. So at 80% capacity when they are operating, they're producing and also selling the products. So the selling price will be total cost, the variable cost plus the fixed cost total cost plus profit margin is selling price. So because they're already operating at 80%, at 80% itself, they would have taken care of the total amount of fixed cost, because total amount of fixed cost is the same till it reaches 100% capacity. So all the amount of fixed cost is already absorbed at 80% capacity level. So when they operate beyond 80% capacity, they do not have to incur any additional fixed cost. Whatever initially it was incurred, that is already absorbed or recovered at 80% capacity operational level. So since they are selling their products at 80% capacity, for these products, the total amount of fixed cost is also included, and that is recovered by the units which are sold. So if they want to operate beyond this 80%, beyond the present capacity level, in that situation, they don't have to incur additional fixed cost. I hope you got the point. Now, additional capacity, when they are utilizing that, all what they would be incurring is only the variable cost, because the total fixed cost was already recovered by selling products at 80% capacity. So no more fixed cost is needed to be absorbed. So the selling price will be as low as variable cost plus the profit margin. So selling price is calculated conventionally. Regular method of deciding on selling prices, total cost plus profit margin is equal to selling price. But we also see that some certain situations, the selling price is as low as variable cost plus the profit margin. How to calculate what's the margin? Margin is calculated to generate a specific return on sales or investment. So some percentage is calculated and it is added to the present situation. So how is that calculated? It says that margin is calculated to generate a specific return on sales or investment. So return on investment can be calculated as, for the total amount of investment, how much profit do they want to earn. Based on that, the profit margin is calculated, or the profit margin on the sales value, the number of units which are sold on the sales value also, it is decided. I hope that's clear. We move to the next topic, which is called as planning and control. The areas what we are going to learn now here is standard costing, integrated accounting, budgeting, preparing management reports, and performance measurement. So these are the topics what we are going to learn under planning and control. So out of the list, to begin with, we start with what is standard costing. What is the concept of standard costing? So there are standards which are decided with future period. So according to the standards which are decided, they have to take up or they have to spend the actual amounts matching with the standard. So it's kind of a budget which is prepared in terms of deciding the standards, how much should they be spending. um, See, for an activity level, what is the standard to do to take up an activity level for this kind of activity? How much is the total cost incurred? So that is what is estimated, and it is used as a reference sake. So how much should they be actually spending? So for all the elements of cost, that is material, labor, and overheads, standard amounts are decided. Standard amounts are pre-decided, calculated, and they are kept available. On a similar note, we see that standards are also available for revenue related things. That is, how many number of units, how many number of units um, are to be produced and sold, and at what selling price would these be sold. So there is a standard value which is already decided. Then when the actuals take place, the actual cost or actual revenue is used to compare the standard costs or the standard prices, understand whether they whatever is decided they have implemented accordingly or there is any variation. What is standard costing? A control technique that reports variances by comparing the actual costs. When they actually spend these actual costs are used to compare whatever is recorded in the pre-decided standard costs. So actual costs are compared with the standard cost. If there are deviations, what kind of deviation? Is it a favorable deviation or an unfavorable deviation? Is first understood. So standard costing is a control technique that reports variances by comparing actual cost to preset standards, facilitating action through management by exception. Management by exception is a situation where the actual is not matching with the standard. There is an exception. So focus will be diverted towards that exception and then they start probing into that. A standard cost is a planned unit cost of a product, component, or service. In this context of standard costing, let's first understand how are standards decided. Randomly, do they decide anything that this should be the standard? No. There are certain things which are taken into consideration. First, we see the ideal standards. What are ideal standards? Ideally speaking, the best thing would happen without having any excuses or the best possible efficiency is reflected. So considering that, but is it possible all the time that an ideally or the best situation would prevail? It is not so. But if they go with the assumption that everything will be fine and will be best happening, so if standards are decided according to that assumption, these standards are called as ideal standards. Okay, the best, ultimate, the best thing what can be achieved. This ideal. Uh, but there are this ideal situation to prevail is not a possibility all the time. Then because see there may be some breakdown of the machinery or laborer are on leave, absenteeism, availability of something is may not be possible, material, other resources may not be possible. So we see that some percentage of the work is not possible to be achieved because of so many restrictions. So we see that attainable standard, what is currently possible to be achieved in normal working conditions, what can be achieved is attainable standard. Efficient operating conditions includes allowances for wastage, any kind of wastage which happens normal in the normal course of business. So that has to be taken into consideration and understand what are attainable standards. Fine. Then we have another thing that is what are current standards, current operating conditions. no incentive to improve efficiency. So at the current level, current operating conditions are the current standards. So if whatever is at present the situation, that will be taken to be as the standard. So no incentive to improve efficiency. Then basic standard is set for the long term, highlights changes in the cost. So that is the basic standard. One is ideal standard, one is attainable, currently possible to achieve the targets, that is attainable standards. We have current standards and then basic standard for long term. What are the uses of standard costing? Performance management, inventory valuation, setting selling prices, budgeting, management by exception. So we see in these areas standards are applicable. These are the areas where standards are applied and used. Now, how are the standards decided? So basically, broad categorization is um, categorization of standards are decided for revenue related and cost related. So if it is revenue related, then we see the selling price and the number of units, so that will be taken into consideration, and there are certain variances which are calculated. But when it comes to cost variance, so cost variance is there are three elements of cost which are considered. One is material cost, labor cost, and overheads. Overheads are again subclassified as variable overheads and fixed overheads. So variances are calculated for material related items, labor, and then overheads. So we see material, labor, and variable overheads, they are on a similar note. How do we calculate what is the material cost variance? So if at all, if we have to find out what is the material cost variance, what is variance? When the standard cost of material is decided and when they actually spend the amount of cost per material, actual cost of material, standard cost of material, these two things are compared. If they match with each other, no problem, there is no issue, there is no variance. But if they do not match with each other, then we call that to be a variance. So there is a variance existing there. When the standard cost of material is decided, that is called as standard cost of material. When they actually spent cost of material, that's called as actual cost of material. Standard cost and actual cost, they both are taken into consideration. Actual is compared with standard. They both match, no issue. They do not match, uh, if they do not match with each other, then there is a variance. So this variance could be a favorable variance or an unfavorable variance, that I will explain in a short while. So how do we compare? What is the cost? So we have the standard cost of material. How to decide what is standard cost of material? The standard quantity into the standard selling price or the standard price of the material. So let's write it as standard price. Standard quantity into standard price gives us what is the standard cost of material. Okay, this is standard cost of material. Then we also take the actual cost of material, that is actual cost, actual quantity into the actual price. This gives us what is the variance about cost variance. See, if there is a standard amount decided, so they are allowed to spend less than or equal to that amount. If they exceed more than that, that results in a variance, and that variance is an unfavorable. See, 50,000 is decided the amount of material cost, They are allowed to spend to the extent of 50,000. If they end up spending more than 50,000, so they are not adhering to whatever are the standards decided. So they are not following that. That is an unfavorable situation. But let's say 50 is decided as the standard, they spend only 45. So which means that there is a variance here, but they have utilized less than what is given to them. So to do a piece of work, if 10 hours are allotted, if somebody uses only 9 hours, then that is time saving. So that is favorable in nature. So here also cost is allotted, some amount of cost is allotted. If they do not spend as much as the cost, then um, that is a favorable scenario. So favorable, unfavorable, some other time again after a while also I will explain that. See, there are two components basically here. One is a quantity component, one is a price. So that is what we see. So cost variance is again further classified into, we have a price variance. So this is material price variance, and also um, another thing which is called as material quantity variance. Quantity variance, we call it as material usage variance. The quantity, how much quantity is used. So price variance is basically, if you put it as, price variance is the difference between the two prices. What are the prices? The standard price and the actual price. So we are only focusing on what is the difference in the price. How much standard price did they decide, and what is the actual price? So is it on the variance? Is it on account of the price? Okay, the difference between selling price and actual price applicable for the total actual quantity. So that's how material price variance is calculated. Coming to the usage variance. So usage variance will be the difference between the quantities used, that is standard quantity minus the actual quantity. The quantities which are consumed, is there a difference in that applicable at the standard price? Then again, material usage variance is split into mixed variance and yield variance. You will not learn about mixed variance and yield variance, at least now. It will be learned in the advanced level. So when you move to P1 and P2 and all, at that time you will learn. But right now, I think you will not be learning uh, about these things. So I said the same scenario applies to the labor also. Let's once visit the presentation and then come back again. So we see the material variances. The total material variance is the total cost variance. Is split into material price variance and material usage variance. Then again, we have to understand why does a variance arise in the first place. So the variance arises because of wrong estimation. All the time, one important thing is they were unable to estimate it appropriately. So wrong estimations is one major reason. Apart from that, um, the prices also fluctuate. When they plan whatever is the price, they assume that to prevail in the future as well. Therefore, they decide on the standard price. But suddenly, some unexpected event may happen, and there can be a drastic change in the prices. The actual price may increase or decrease, or something happens, and then that can result in a variance happening. Or the quality of material, the quantity of material which is consumed increases or decreases. That depends on the quality of material. Inferior substandard quality of material, when it is purchased, lot of material gets wasted. So when the material gets wasted, the consumption of material increases. When the quantity increases, there is a variance arising. So better or lower quality. Sometimes superior quality material is purchased, so less quantity is consumed, nothing will be damaged or destroyed. So every piece of it is properly used. So on that note, that is um, superior quality material or inferior quality material also can result in a variance arising, uh, then more or less wastage expected. So these are the reasons what we can see why would there be a variance arising in the first place. In all situations we can take that estimation was not appropriate, more quantity was consumed because of superior or inferior quality of material, more or less quantity is consumed. Prices also have varied, um, some unexpected events have happened and then that resulted in the price rise or price fall in the material. So therefore variances arise. So you should be able to ponder upon what are the reasons why there is a variance arising in the first place. There is an example question also which is given here. We will be looking into that. Then on a similar note, we also see the labor variances. So I will write it here. And on a similar note, we also see the variable overhead variances. So let's get back to the this one. So in wherever material is there, we can present it as labor cost variance. But quantity is not used in labor cost variance. So what is used? Time or hours are used. So we have it as standard time into standard price. We call it as standard time or standard hours or whatever it is. Basically, it indicates the time. Standard time into standard price, then minus actual time into actual price. Actual time into actual price. Then in place of material price variance, we call it as labor price variance. So here it would be wherever M is there, we would replace it with L. So wherever quantity is there, we will call it as actual time into the standard price minus actual price. That is for labor price variance, standard price minus actual price. And coming to the usage variance, we don't call it as labor usage variance, but there is another term which is used. How much time is used is the concept, but the term is mentioned as labor efficiency variance, LEV, labor efficiency variance. This is in terms of how much time is allotted, how much time is consumed. So the difference between the standard time and the actual time applicable at the standard rate. So the logic is the same. The terms differ depending on each situation. So this is actual time applied at the standard rate or standard price, or what we call it as standard rate also. Standard price or standard. Similarly, we also have it as variable overhead um, variances. Variable overhead variances, variable overhead cost variance will be the standard price will be variable overhead rate. Now, in case of variable overheads, it could be quantity, it could be time. So, depending on whatever is the situation in the particular question, we can apply it either to be as quantity or we can take it to be as the time also. So, variable overhead cost variance is split into variable overhead expenditure variance and efficiency variance. So, these are the two variances. Then we have sales price variance. Okay. So then fixed overhead variances are also there, but I think at BA2 level, it is not discussed. So there is one example. Let's look into this example. It says that standard material cost per unit 4 kgs at $8 per kg. So the total cost of material is 32. Actual cost of material for 500 units is given as 14,700, that is at the rate of 2,100 kgs into 7 per kg is 14,700. So we are asked to calculate what are the variances. So when standards are decided, the standards are decided per kg for 1 unit per kg, for how much material is used for making 1 unit, but the actual activity took place at 500 units. So we cannot compare 1 unit details with 500 units. So 500 is the actual activity which has taken place. So the standards now will be enhanced to match with the actual activity level. So first we need to find out what is the standard cost of 500 units. So make everything for 500. So 1 unit, if it is 4 kgs, 500 units, it will be 500 into 4 into 8 gives us the standard cost. Actual cost anyway, it is given as 14,700 directly calculated. The difference between these two will be material cost variance. Now that's split into price variance and usage variance. Price variance is the difference between the standard price and the actual price applicable for the actual quantity. What's the actual quantity? 2,100 is the actual quantity of material. Okay. Now find out the difference between the price. The difference between the price is 2,100. No matter how it is presented, I'll just explain you the logic. 2,100 is the quantity of material. The difference between the standard price. What is standard price of material? $8 per kg. 8 minus actual price of material is 7. So 8 minus 7 is 1. 1 into 2,100 is 2,100. They have decided the standard price to be as 8, but they spent only 7. So it's a favorable situation. 2,100 is a favorable situation. Then coming to usage variance. Usage variance is how much did they use? Okay. How much did they use is actual usage is 2,100. Standard usage will be 500 into 4. That is the actual quantity, the standard quantity. The standard quantity for 500 units will be 500 into 4. So it is 2000 kgs. So when 2000 kgs is the standard quantity, so we have the difference between the standard quantity 2000 minus actual quantity is 2100. This is applied at the standard price. What is standard price? Standard price we have it as 8. So into 8. So 2000 and 2100 difference is 100. 100 into 8 is 800. But is it, we don't write negative signs, but we just mention whether it is favorable or unfavorable. Now since the quantity decided is 2000, but they consume more than what is decided, 2100. So that 100 is additional consumption. So that results in an unfavorable or an adverse variance. Unfavorable or adverse. They are supposed to consume only 2000, but they ended up consuming 2100. So it is an unfavorable or an adverse variance. So that is the material usage variance. I hope it is clear. Any doubts? I'm really sorry, at the beginning of the class, I assumed that I took you to the Excel sheet, but maybe jumping from one tab to another tab, I made a mistake. But then again, I think we can cover it up. So did you understand this part of it?
Yes, ma'am.
Okay. We'll continue tomorrow. So we will be looking into, very little will be left in variances. We will also look at the sales variances.
Ma'am, can you mail me this? revision card. I was
Revision.
not able to. I was not able to get it from the website.
Revision cards you want? Done. I will.
Ma'am, should I put it in the chat box? My mail.
I don't have your mail. You give me your WhatsApp number, so I'll send it to your WhatsApp. Put your WhatsApp number.
Ma'am, it's put on what?
Okay, after the class, I will send it. Okay, so we'll continue tomorrow with the other things and then proceed further. Fine. Okay, good day.